Welcome back to the Dinar Daily, your unfiltered source for in-depth analysis on one of the most discussed financial topics of our time. For years, the subject of international currency reevaluations has existed on the periphery of mainstream financial dialogue, often discussed in specialized investor forums and largely set aside by conventional economic analysts. However, the tone of this conversation has started to shift in a noticeable way. What was once relegated to speculative corners of the internet is now a subject of quiet but serious examination within more established financial circles. The discourse is evolving, moving from theoretical possibility to a topic of strategic analysis, prompting a closer look at the underlying economic and geopolitical factors that are fueling this growing interest. Among a wider audience of market observers, the increasing attention being paid to this narrative is not without cause. Analysts who track global capital flows and macroeconomic trends have begun to point toward a series of subtle but significant indicators that suggest a potential realignment may be under consideration in various parts of the world. Conversations that were once theoretical are now being supported by observable actions in the market, as certain institutional players appear to be positioning themselves for shifts in currency valuations. This change in posture from major financial entities has lent a new layer of credibility to the discussion, forcing even the most skeptical economists to acknowledge that the dynamics underpinning the global monetary system may be in a state of flux, driven by powerful economic forces that are becoming increasingly difficult to overlook. The narrative gaining momentum suggests that certain national currencies, which have long been considered undervalued relative to their country's economic potential and natural resource wealth, might be approaching a significant correction. In particular, the Iraqi Dinar and the Vietnamese Dong have become central to these discussions, each for distinct but compelling reasons. The core idea is that the current exchange rates for these currencies do not accurately reflect the fundamental economic strength and stability their respective nations have worked to build over the last decade. As global economic power continues to shift, the argument for a monetary recalibration that brings these currencies into alignment with their intrinsic value is reportedly gaining traction among a diverse group of international economic strategists and sovereign wealth managers. This growing chorus of analysis is not based on rumor alone, but on a confluence of observable trends. The persistent accumulation of foreign reserves, disciplined fiscal policies, and strategic modernizations within the banking sectors of nations like Iraq and Vietnam are creating a foundation for greater monetary stability. These internal reforms are occurring alongside significant external geopolitical shifts, including the rise of new economic alliances and a growing global push to diversify away from traditional reserve currencies. It is this powerful combination of domestic progress and international pressure that has led many observers to believe the world may be on the cusp of a significant financial turning point, one that could reshape trade balances and international investment flows for years to come. The perceived sense of a gathering momentum is palpable in certain financial communities. The alignment of various global trends, from the digitization of assets to the mounting sovereign debt crises in major Western economies, appears to be creating an environment ripe for change. Analysts are increasingly pointing to a potential recalibration of the global monetary order, an event that could rewrite the established rules of modern finance. For those who have been patiently monitoring these developments, the culmination of these economic and political forces represents the potential validation of a long-held thesis that the true value of a nation's currency must eventually reflect the strength of its underlying economy, a principle that may soon be put to the ultimate test on the world stage. Market behavior, when examined closely, often provides clues that public statements do not. In recent months, analysts have noted subtle shifts in institutional investment flows and sovereign debt positioning that seem to anticipate changes in the foreign exchange landscape. The whispers of a financial reset or recalibration are no longer confined to informal channels but are reportedly emerging in sophisticated economic modeling and private briefings among high-level financial entities. When significant capital begins to move in anticipation of currency shifts, it is typically driven by extensive data analysis and strategic foresight rather than speculative hearsay, signaling a deeper conviction among those with substantial assets at stake. The actions of sovereign wealth funds, for instance, are often seen as bellwethers of long-term economic trends. Reports from financial intelligence sources suggest that some of these massive funds have been steadily increasing their positions in key frontier markets, including Iraq and Vietnam. This activity indicates a growing recognition of the potential undervaluation of these nations' currencies and a strategic decision to gain exposure before any potential revaluation occurs. Even the traditionally conservative banking sector has shown signs of preparation, with some institutions reportedly adjusting their regional liquidity exposures in a manner that would mitigate risk and capitalize on any significant currency realignment. In these key emerging markets, the convergence of these behaviors across different sectors of the global financial system points toward a quiet but deliberate reorganization. It suggests that a broad range of sophisticated financial actors are independently arriving at a similar conclusion about the future of certain undervalued currencies. The potential implications of such a coordinated, albeit unstated, shift are staggering. If currencies like the Iraqi Dinar or the Vietnamese Dong were to realign to more accurately reflect their nations' true economic strength and resource wealth, the ripple effects would be felt across the entire global financial architecture, altering wealth distribution, trade dynamics, and geopolitical influence in a remarkably short period. What was once dismissed by many mainstream commentators as a fringe theory is now being examined with a level of seriousness that reflects the changing economic realities. The sustained economic progress in countries like Vietnam and the steady institutional reforms in Iraq are providing a solid, data-driven foundation for a new valuation narrative. Financial foresight is often about identifying and understanding these fundamental shifts before they become obvious to the broader market. As more institutional players begin to act on this foresight, the possibility of a significant currency revaluation event moves from the realm of speculation closer to a credible, strategic scenario being modeled by a growing number of financial experts. Vietnam's economic journey over the past 20 years is a powerful example of disciplined growth and strategic planning. In the early 2000s, the nation was primarily viewed as an emerging economy with potential, but it has since undergone a remarkable transformation into a global manufacturing powerhouse. Through a combination of consistent industrial expansion, the signing of key strategic trade agreements, and careful fiscal management, Vietnam has built one of the most dynamic and resilient economies in Asia. This steady, deliberate progress has created a compelling case for a re-examination of its currency's valuation, which many analysts argue has not kept pace with the country's impressive economic development. A key factor in Vietnam's success has been its ability to position itself as a reliable and cost-effective alternative to China for global manufacturing. As production costs rose in China, a massive migration of factories and supply chains occurred, with Vietnam emerging as a primary beneficiary. The nation adeptly absorbed this influx, rapidly scaling its infrastructure and workforce to become an essential hub for the production of everything from consumer electronics to textiles. This strategic pivot has not only fueled its export-driven growth, but has also established Vietnam as a cornerstone of global supply chain reliability, a reputation that has immense value in today's interconnected and often volatile world economy. Today, Vietnam's strong macroeconomic fundamentals provide a solid basis for international recognition of its currency, the Vietnamese Dong. The country boasts a low debt-to-GDP ratio, an expanding trade surplus, and substantial foreign reserves, all of which are indicators of a healthy and well-managed economy. Prominent financial institutions and analysts have taken note of these strengths, highlighting the growing credibility of Vietnam's central bank and its disciplined approach to monetary policy. While a formal revaluation is a complex process, The underlying economic data suggests that the dong is positioned for a significant upward adjustment that would better reflect the nation's genuine purchasing power and economic output on the global stage. The possibility of a substantial rise in the value of the dong is increasingly being discussed in sophisticated financial circles. Trading activity in dong-linked derivatives in major Asian financial hubs like Hong Kong and Singapore has reportedly seen a significant increase, suggesting that institutional investors are actively hedging against or positioning for a potential revaluation. Furthermore, wealth managers across Asia are said to be quietly advising their high-net-worth clients to secure positions in the Vietnamese Dong as a long-term strategic holding. These actions indicate that the concept of a dramatic upward correction for the dong is no longer viewed as mere speculation, but as a plausible outcome of Vietnam's deliberate and successful economic engineering. Similarly, the Iraqi dinar carries a unique and compelling narrative, evolving from a symbol of a nation's turbulent past to a potential cornerstone of future regional economic stability. Iraq's economic transformation, while gradual, has been profound. Anchored by some of the world's largest proven oil reserves, the country has also made significant strides in growing its non-oil GDP sectors, diversifying its economy, and building robust partnerships with international financial institutions. This multifaceted approach to economic development has allowed Iraq to quietly stabilize its financial architecture and lay the groundwork for a stronger, more resilient currency. At the heart of Iraq's economic resurgence is the Central Bank of Iraq, CBI, which has implemented a series of ambitious reforms aimed at modernizing the country's monetary system. The CBI has focused on enhancing transparency, improving foreign reserve management, and bringing its operations into compliance with international standards. These efforts have been crucial in strengthening the dinar's convertibility and building confidence among global financial partners. In parallel, the government's focus on economic diversification, particularly in sectors like agriculture and technology, is creating new revenue streams and reducing the nation's historical dependence on oil exports, further supporting the case for a more valuable currency. Analysts are closely watching key indicators of Iraq's progress, such as the steady growth of its fiscal reserves and the increasing stability of its exchange rate. These metrics are often seen as essential precursors to any potential currency revaluation. Furthermore, reports from private intelligence groups, though unconfirmed, suggest that regional banking networks are making preparations for a possible upward correction of the dinar. The circulation of speculative projections, some reaching optimistic levels, reflects a growing confidence in Iraq's macroeconomic recovery and its potential to re-emerge as a significant player in the regional and global economy. For the many international observers who have followed Iraq's journey for years, the current alignment of factors is particularly noteworthy. The combination of comprehensive regional reforms, substantial oil-backed revenues, and increasing international recognition of its progress has created a unique moment in the country's history. The long-anticipated transition from a period of patient waiting to one of tangible witnessing may be approaching, as the structural improvements within Iraq's economy begin to translate into a stronger foundation for its national currency, a development that could have far-reaching implications for the entire Middle East. What is unfolding in Vietnam and Iraq should not be viewed as isolated national events, but rather as part of a potential global financial turning point. The interconnectedness of modern markets means that a significant currency adjustment in one key region can set off a chain reaction of recalibrations across the world. The simultaneous strengthening of frontier market currencies, coupled with developments like Zimbabwe's introduction of a gold-backed currency, may reflect a broader dissatisfaction with the traditional fiat currency paradigms that have dominated the global financial system for decades. This potential shift is occurring against the backdrop of significant economic strain in many Western nations. Persistent inflationary pressures and historically high levels of sovereign debt are creating challenges for traditional reserve currencies, leading many investors and nations to seek out alternatives. In this environment, countries with tangible assets, such as vast oil reserves or strong manufacturing bases, and those that have demonstrated disciplined fiscal management are gaining significant economic leverage. This is prompting a fundamental rethinking of where true value lies in the global monetary system. Wealth managers and institutional strategists are increasingly advising diversification not just through traditional assets like equities and bonds, but through holdings of undervalued currencies that are tied to real, tangible economic growth. The possibility of a synchronized revaluation event, whether it occurs through a coordinated international agreement or as a natural consequence of market forces, represents more than just a potential for profit. It signals a potential redistribution of global economic power, with emerging nations playing a much larger and more influential role in shaping the future of finance. The Central Bank of Iraq's sweeping reforms are a critical component of its strategy to reintegrate into the global financial ecosystem. These reforms have targeted transparency, fraud prevention, and the modernization of its digital banking infrastructure, all of which are essential for meeting international compliance standards. By forming partnerships with Western auditing and cybersecurity firms, the CBI has worked to fortify its financial oversight and build a system that can be trusted by international partners. This methodical approach is designed to create a stable and secure financial environment capable of attracting foreign investment and supporting a more valuable national currency. While global attention is often focused on the Middle East and Asia, Zimbabwe is quietly crafting a remarkable comeback story in international finance. After a period of extreme hyperinflation and economic collapse, the nation has embarked on an ambitious journey to restore credibility through the launch of its new gold-backed currency, the Zimbabwe Gold (ZiG). This represents a decisive break from the inflation-prone fiat systems of its past, as the ZiG is explicitly tied to the country's substantial reserves of physical gold, rooting its value in a tangible asset rather than government decree. The introduction of the ZiG has already captured the attention of regional and global observers, particularly within economic alliances like BRICS and development forums of the African Union. Early indicators suggest growing adoption of the currency within the region, as well as interest from private investors seeking exposure to gold-anchored financial instruments as a hedge against global fiat currency uncertainty. If Zimbabwe successfully follows through with its plans for third-party audits and formal verification of its gold reserves, the ZiG could transition from a national stabilizer to a continental benchmark for asset-backed currencies. Perhaps the most intriguing signals of a potential global currency shift come from the quiet, coordinated behaviors reported within major financial institutions. Over recent weeks, unverified reports have emerged from the banking sector indicating that global giants have circulated internal communications referencing temporary updates to their foreign exchange rate tables. Some departments have reportedly implemented brief rate blackouts, restricting access to live foreign exchange feeds while citing system maintenance. Such events, while officially explained as routine, are considered highly unusual by market veterans and often precede significant monetary policy shifts or reevaluations. This pattern of behavior is not without historical precedent. Similar disruptions were observed in the interbank systems just before the historic post-war revaluation of the Kuwaiti dinar in the early 1990s, when rate tables temporarily vanished before reappearing at dramatically different levels. Adding to the current intrigue are anecdotal accounts of private wealth advisors discreetly encouraging select clients to increase their holdings in certain emerging market currencies, framing it as a prudent measure against potential regional realignments. While none of these indicators provide official confirmation, their reported synchronicity across multiple institutions suggests a coordinated posture that many market watchers find difficult to dismiss as mere coincidence. In any scenario involving significant financial transformation, meticulous preparation and due diligence are paramount. Observers of such events often emphasize the importance of identifying reputable financial institutions authorized to facilitate exotic currency exchanges and thoroughly verifying their policies and authentication protocols. Careful documentation, including receipts of purchase and certificates of authenticity, is also considered a critical component of navigating complex financial transactions. In an environment where misinformation can spread rapidly, a disciplined approach to verification, relying exclusively on regulated entities and verified market data platforms, is essential for maintaining clarity and making informed decisions. The global financial system appears to be standing at a pivotal threshold, a moment where long-suppressed value realignments could potentially redefine how currencies and capital interact across borders. The narratives of the Vietnamese Dong and the Iraqi Dinar have evolved from speculative curiosities into symbols of a broader macroeconomic awakening, one that is tied to the gradual unwinding of the old financial order. As the invisible architecture of global finance continues to shift, the emphasis remains on strategic readiness and a deep understanding of the underlying economic fundamentals that will ultimately determine value in the new monetary era that may be dawning. Disclaimer: the information presented in this program is for educational and informational purposes only. It does not constitute financial, investment, legal, or tax advice. The content should not be interpreted as an endorsement of any particular currency, investment strategy, or financial instrument. All viewers are strongly encouraged to conduct their own independent research and to consult with qualified, licensed professionals before making any financial decisions. All statements and opinions expressed are based on publicly available data and commentary and should be considered speculative in nature. Currency markets are inherently volatile and subject to a wide range of unpredictable variables.